What is up, bosses? Before we kick off this episode, I want to tell you about our sponsor this week, 2022. It's a brand new year, but we're still talking about Indeed.com. In fact, they are our longest running sponsor of the podcast. So we hope you'll give your support as well, especially if you're hiring to build a team with the right skills to make your dreams a reality. In fact, if you're hiring, you need Indeed, because Indeed is the hiring partner where you can attract, interview, and hire all in one place. Indeed is the only job site where you're guaranteed to find quality applications that meet your must-have requirements, or else you don't pay. And one of the things I really love about Indeed is that they have this thing called Instant Match, where it gives you quality candidates as soon as you post a job. In fact, Indeed data says that over 90% of employers get those candidates right away when they use Instant Match. I'm going to tell you even more about Indeed during the break in the show, but if you want to get started right now, just head over to Indeed.com/ILAB. We're going to give you a $75 sponsored job credit to upgrade your job post. Just go to Indeed.com/ILAB. Get your $75 credit. That's Indeed.com/ILAB. Offer expires March 31st. Terms and conditions apply. Need to hire? You need Indeed.
Welcome to the Invest Like a Boss podcast.
I'm Sam Marks.
And I'm Johnny FD. We're self-made entrepreneurs who invest our own money and use modern technology to invest like a boss.
Join us each week for exclusive interviews with our network of modern investors, business owners, and multimillionaires to discover new ways to invest our hard-earned cash.
What's happening, bosses? Episode 213 of the Invest Like a Boss podcast. I am Derek Sparts, joined here in Los Angeles. Sam Marks is on the other end out in Barcelona, Spain. I say it's episode 213, but it's more of a episode 101. Sam, how you doing, buddy?
I'm doing good. And you're trying to pin me down to Barcelona, but I have escaped. I'm outside, afuera de Barcelona. I actually just finished a yoga retreat. Yes, indeed. That is me. Getting all elastic and flexible for the new year. And what is today? It's Monday. I just drove, I took a train back to Barcelona and then got in a rental car and drove up to the Pyrenees. So I'm circa de Andorra, right next to Andorra. And dude, it was so awesome because you can't get out here on the weekends. Like if you leave Friday afternoon, it is so insanely busy and it takes like 6 hours to get here by car. But if you go on a Monday, there is no traffic at all. It was amazing. So you see all these cars coming back towards Barcelona, but I'm literally the only car on the road out here. It's like you got the whole mountain to yourself.
One of the beauties of working for ourselves and not having that normal Monday through Friday 9 to 5 job is you can avoid those crowds. And I should have known better by now, Sam, to just assume you're in any single one place.
Sometimes we take these things for granted, but I really felt privileged on this ride out today. I was like, man, this is awesome, you know, because everyone hates fighting to get out to the mountain and the lines and all that stuff. It like kind of takes away the appeal of skiing. But one of the beauties, like you said, of investing and making compounding interest, which is going to be the 101 back to the basics episode. And we're going to dazzle you with some math. We're going to go back to school today, Derek.
I'm excited for it. So let's try to get some of that privilege onto our listeners as well. We're talking compounding interest. Now, this might be one of the first things that got us invested or a lot of other people. And some people, honestly, might not even know about it. Maybe you heard it from a grandparent or something on the web. You saw some YouTube video where someone was talking about this compounding interest and it just didn't make sense. So I think we're here to break it down to the basics and show you that it's really not that hard to figure out. And if you put a few simple principles in place.
Yeah. So on a positive note to start the year, because we always have things that we get hung up on. We got all these goals ahead of us. But sometimes you reflect and you're like, man, I didn't hit my goals last year. And it's a little bit of a downer, but we're here to get you spruced up and motivated for this new year. And it's, even if you're a seasoned investor, being reminded of the power of compounding interest is very important to think about because it helps you stay disciplined in your investing that you've probably been doing for a while. And if you're a beginner, it's never a better time to get started now, because you're going to see in this episode and with some of the visuals that we have that time is an extremely important variable when it comes to compounding interest, if not the most important. And honestly, the numbers are insane. The numbers are insane. So we're gonna dive deep into it on this episode.
Yeah, I wish I would have got it started earlier on this and thought about it. In the last few years, I've really focused, but had I done it, 10 years earlier, I'd be a lot further than I am right now. Things are great, but they could be even better if I had followed these principles, or if Invest Like a Boss was around back then. But there's never too late to start. So the sooner, the better. We're going to do the math. It all works out. So, sit down, enjoy. Get an extra coffee. I just finished mine. I feel like I need another one, but you ready to get into it, Sam?
Yeah. And speaking of, I had a 3-day coffee detox. And for anyone who's done a coffee detox that drinks coffee every day, damn, that is a bad hangover.
I just had the same problem yesterday. I didn't have my first cup till like 2 p.m. and I paid for it the whole day.
Yeah. It's brutal. It's like, and when you have that coffee, it doesn't actually like immediately remedy it. It's like you're still stuck with it. So you got to get it in before that headache comes on. So yeah, let's kick it off. So for any of the Patreons, we've got visuals. This can be a little bit of a different episode to our typical format. It's almost like a lecture series. So we're going to be going through a 17 frame slideshow. So it'll be visuals for the Patreons, but if you're just listening in, you're going to enjoy it anyways. So let's kick it off, Derek.
All right, so here we go. In case you're new to the show, we'll just do a quick explanation of who everyone is. Maybe I'll have Sam speak to his part really quick. Sam, why don't you give us a quick 30-second pitch on what got you to where you're at today and kind of what inspired it?
Well, mine's like a quick 5 words, but basically the three of us are we're similar in what we're trying to accomplish, but we've all taken different routes to financial success. And I think that's actually part of the very interesting thing about the podcast, is because our listeners can relate to the three of us differently, because we all are taking different paths. So I took the hyper entrepreneur route. I was all in, living on noodles and just swinging for the fence. I was basically earning nothing. I was investing everything in equity, in building my own businesses. And that's how I found success.
Awesome. And then we got Johnny, who's not with us today, but if you listen to the show, you definitely know about Johnny. He definitely took a more practical route, but at the same time, it was a little extreme compared to, say, the average person living in the US, I would say. He was really disciplined about saving. He actually did not make a lot of income, but he saved a ton of it. I don't know the exact percentages. He could speak to that, but it's way over half of his income he saved. He used location arbitrage. He initially moved to Thailand, which is insanely cheap if you're not familiar. And Johnny's insanely cheap. So, we
like to say he mastered the art of frugality.
Definitely. And he's still living to that today, and he's become a millionaire. So it's worked. He also utilized a lot of online income to grow his business. And he's essentially today retired, minus some, I'd say partially retired at least, and living in Kiev, Ukraine right now. And he's about to be traveling again. I think COVID kind of got to all of us and kind of changed our travel plans. He settled down a little bit more, but he used to be that guy too, where every 2 weeks he was in a different spot. A little different now, but I think he's about ready to get back to that again as well. So Johnny definitely took a really conservative route where it was save, and live as cheap as possible. And then I'm kind of a little different from both these guys. I like to hustle. So I used to work, a regular job, and finally realized that it doesn't pay off. It's never going to pay off. If you want to be stuck in that route forever, some people love it and some people just can't do it. And I was one of those people that couldn't do it. And I was actually forced into being laid off from my job it was a great kick for me to kind of get out on my own and work for myself and realize that I don't need a large company to pay me and take care of me. Like, I can do all this stuff myself. So it's multiple jobs, saving. I've definitely saved over half of my income in the last 3-4 years. And as we're going to talk about here with compounding interest, it started off slow and then it just builds and builds and builds. And I've been able to do all this while, against Sam and Johnny's advice, still live in a very expensive city of Los Angeles, California. I love it here though. And I see their philosophy of living somewhere cheaply But also at the same time, there's so much opportunity in LA. If you're from here, there's so many ways to make money that I just don't see in these other cities. And the fact that it does cost a lot more, you also have potential to make so much more money at the same time. So I'm kind of mixed on the fact of moving somewhere cheap, and because I definitely take a hit to my income as well. So I think for now, I really like LA and I'm going to stay here. So it's a mixed opinion on what you think about the location arbitrage.
Yeah. So I think between the three profiles there, most people can relate. And what I like about Johnny and Derek's is, of course, I like mine better. But,
I like your bank account better.
Yeah, but Johnny's and Derek's is the more practical route where if you just follow the steps, anyone can do it. It takes discipline, it takes hard work, but it's available for 90% of the people out there. The entrepreneur route is a faster route potentially, but you can also end up in a really bad spot and you can swing and miss your entire life. So those are three different routes, but let's get into the meat and potatoes of compounding interest, because that is something that all three of us are doing and trying to take advantage of.
All right, here we go.
All right. So first, let's establish what the actual financial dream is. And I think we probably hear this the most and you read it in a lot of different places, is to generate enough income passively to be able to live your life. And forever, that was mine. I'm like, oh, that's the dream right there. If I can just live off of interest or dividends and live my life, that's great. But what I realized is if you stop there, it's basically like living paycheck to paycheck. You know, if you make $10,000 a month passively, but you're spending it all, your principal is staying the same, which means you're actually losing money to inflation. So we kind of augmented that thesis and we changed it into the generate enough passive income to support your lifestyle that you want, while also having your investments appreciate in value and grow in net worth over time. So you're covering your lifestyle, but your bank account and your assets you are going up and you're still creating more wealth passively. Now, who's the big boss in town when it comes to investing? It's Mr. Warren Buffett. Everyone knows the name.
The Oracle of Omaha.
Yeah. What's his advice when it comes to investing? Because, people ask him all the time, right? And it could get very complicated if he wants to, but he keeps it simple. He says, stick 90% of your money in the S&P 500 index, keep 10% in short-term US treasuries, and get back to work. And in fact, I think this is what he's sort of mandated in a sense to his whoever's inheriting all of his money. It's like, hey, don't try to do what I'm doing. Just put it all in the S&P 500, keep some in treasuries. And the 10% in treasuries, people kind of ask, well, what's that all about? And it's not because that's a great investment. That's your cash. That's your cash equivalent, so that you don't make a huge mistake when the market goes into a down cycle and you have to liquidate some of your investments, which is like the worst investing mistake that you can make. So having it in treasuries is slightly better than having it in cash, but it gives you the ability to have an emergency fund, which we talk about as a basic fundamental thing that you need to have before you start investing money in the market. Well, one thing that's actually funny before we get into Mr. Albert Einstein is that if I had taken Warren's advice when I started investing going back, say 10 years ago, I would have been way, way, way up compared to where I'm at now, having some like 55 different investment accounts, right? Diversified across like everything across the globe. And if I had just stuck with his advice and put it on the S&P 500, I would be like up 3x from where I'm at now. So it goes to show you, I still wouldn't necessarily do that because I like more diversification, but it's not a bad option. So
I agree with that. I think us hosting this podcast kind of helps and hurts us at the same time. I've fallen into that hyper diversification trap too. I have too many investments, but it's fun. How about Mr.
Fun to do more paperwork.
Yeah. Speaking of, it's tax time as we record this. How about Albert Einstein? His quote was, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." I think that's a good point that you see a lot of times that people just say, "Oh, I don't understand the financial system," or "I don't get it," and they're stuck in this rut where they're never going to get ahead in life. But the people who have figured it out, and it's not that hard, as we're going to show you, are just crushing it.
Just crushing it. And I thought a little bit about what he meant by when he said, "He who doesn't pays it," and it's inflation, right? If you're not investing and you don't understand compounding interest and you don't understand inflation, you you basically keep your money uninvested in a bank. And that means you're paying compounding interest on the other side because inflation is basically going exponential to a degree.
Right. Or you're taking that car loan or you're running up that credit card and you're paying someone else that interest.
Great point.
All right. So what is compounding interest? Let's just start with the basic definition of compounding interest. It would be when you keep your money invested in assets like a dividend paying stock, you get paid out of your principal you get paid out on your principal passively and at a regular frequency. Usually when we're talking about stocks, this is quarterly, so 4 times a year. When these earnings are added to your original principal balance over multiple cycles, the interest starts to compound. So not only are you getting interest on your initial investment, but you're also getting interest on top of that interest. So over the course of time, this creates an exponential snowball effect. Let's say you have a stock that pays a 5% dividend. So every quarter, you're getting a quarter of that 5%. And then you're not only earning interest from your initial investment you put in, but also interest on top of that additional 5% you put into the stock. So it really starts to add up over time.
Yep. And compounding interest works if you're making 1% or if you're making 30%. It just takes a lot longer to see the effects when it's at 1%. Basically at 1%, you'll just never see the effect in your lifetime. But at 30%, you'll see it very quickly within a few years. So we're going to go into some of the models and some of the numbers now. Now, what I think is really cool is that this will show you, again, if you're watching this, you can see the actual curve of compounding interest starting to go exponential. And that's when it gets really exciting. But we've picked out some base case numbers just to give kind of everyone an idea of how you can make $1 million investing passively. Now, these numbers are not overwhelming, but we just want to give you a base case. So $5,000 yearly, which equates to more or less $400 a month. If you invest that over the course of 40 years, so $400 a month, or let's say $5,000 a year, over the course of 40 years, and you're making 7% interest, which is very achievable historically, you'll have over $1 million. You have $1 million, $1,068,000. And you can see by running the quick numbers, 40 years at $5,000 a year is $200,000, right? So $200,000 turns into over $1 million, 40 years. Now, where you see the exponential curve starting to start is it took you 40 years to make $1 million, right? But it only takes you 9 years to make the second million. And that's the power of compounding interest. We're going to look at some numbers in the next frame that show you even more dramatic. But in 49 years, you'll have $2 million. So it shows you that over the course of time, as the exponential curve starts going, you start making money at a much, much quicker rate. And this is what's getting everyone so excited, and from Buffett to Albert Einstein and, of course, the world's best investors. So let's take a look at some more impressive numbers. So if you're still at 7%, if you have 75 years, what if you have 75 years to invest? Well, if you take that same $5,000 that you're investing every single year and you invest it for 75 years, you now have $12 million. Okay. But what if you make 9%? Derek, because we've all made 9% now historically,
especially recently. Investing. Yes.
Yeah, especially recently. But since we've been investing, we've been making more than 9%. I think my account right now in Vanguard is at over 10%, 10.5%. So if you make 9% for 75 years, again, on just investing $5,000 a year, you have 38 million.
That's a big boss money.
38 million number. And that's why things get so exciting with time and making a little bit extra. And in this chart, you can see the difference in 7% versus 9%. And this is why low fees are so important. This is just a 2% difference. A lot of people, when they first start investing, they think, oh, I can pay an advisor 1%, or if I make 7% or 8%, it's almost the same thing. And it's basically true for a short period of time. But over the course of 40 years, 50 years, 60 years, 70 years, the difference is 38 million compared to 12 million. What is that? 24 million? It's difference in $24 million. Like all achieved passively by just keeping fees down, making 9% instead of 7%.
Okay. This is all great.
This is where people start getting really exciting, right?
It is exciting, but there's one small problem with your chart here, Sam. And I'm going to tease it because we're going to take a super quick break and we'll come back and I'll tell you what the problem is with Sam's chart. This week's episode of Invest Like a Boss is brought to you by our friends over at Indeed.com. 2022. It's the year you're going to make the leap and turn your passion into profit. But to do that, you need to hire the right team. Indeed makes it easy to hire and build a team with the right skills to make your dreams a reality. If you're hiring, you need Indeed. Indeed is the hiring partner where you can attract, interview, and hire all in one place. Instead of spending hours on multiple job sites hoping to find candidates with the right skills, you need one powerful hiring partner that can help you do it all. I'm here to tell you that's Indeed.com. Join the more than 3 million businesses worldwide that use Indeed to hire great talent fast. And you know what? We're going to get you there even faster, because if you go to Indeed.com/ILAB, we're going to hook you up with a $75 sponsored job credit. All you got to do is go to Indeed.com/ILAB, claim your $75 credit before March 31st. One more time, Indeed.com/ILAB. Get to hiring with Indeed and get yourself off to a great start in 2022. Terms and conditions apply. Need to hire? You need Indeed. All right, back here on Invest Like a Boss. I told you Sam just showed us a really interesting chart of how essentially investing $5,000 a year, you can get almost 40 million in 75 years. But I have a problem with it. Sam wants to defend it a little bit more, I think, first.
Well, just to add on to that, how impressive that number is. After 75 years, you had basically $40 million. And the total amount of money that you would have invested over that 75 years, just $375,000. So $375,000 turns in to almost 40 million.
That's
just
wild.
Passively, but you gotta stick it out for 75 years. But the other thing that's worth noting, it's sort of almost like an optical illusion, but the compounding interest curve, the exponential curve, is actually the same if you invest $1 or $5 million. It's just the numbers are higher, right? But you're still going to have that same curve. And that's why the time variable is so important. And then, of course, the returns.
That's a good point. The chart's going to look exactly the same, whether you put $1 in a year or $1 million a year. The chart's going to go up the same rate. But one problem, Sam.
We don't like problems, Derek. We just like making money.
I mean, this is all great, and it's very it's 100% accurate. You're right on this, but here's the problem. Watch this right now. If you can't see it, but I'll tell you what it is in a second. I don't have 78 years, Sam. I don't think I do.
What do you mean, Derek? Look at all this sci-fi, new technology, medicine, and new designer drugs that we're creating.
I keep hanging on to that fact, but I mean, if we want to be realistic, the average human, I think in the United States at least, makes it 78 years. So unless I started at 3 years old, I might not have 40 million in my account. And most of us, to be honest, spend the majority of our money in our 40s. A lot of people don't start investing till age 30. So if you're talking age 30 to 78, it's 48 years. And another thing, if you have 48 years, that's the end of your life, which is probably not your most active time to be out traveling and seeing the world. Another problem, it's really difficult to be disciplined. I'm openly honest. I was not a disciplined investor until maybe the last 5 years. And people are impatient. They don't want to wait 40 years. And people in our generation, Sam, they're more about that experience of life and not, waiting until you retire on things. And they want to do things today. So that doing things today means spending money.
Yeah, these are all fair points. And this is exactly why most people don't stick it out for 75 years so that they can blow 40 million from the retirement home in the villages in Orlando, Florida.
Oh, God, that'd be fun, though. I hope I have 40 million to blow.
There's tricks. So clearly we've established the numbers work. Clearly we've established the problem.
So that's the problem, Sam. How about a solution?
Well, this is it. We all hear these things of the power of compounding interest, but for all the reasons that Derek just described, it's hard to stay disciplined. But there's tricks. There are tricks. So first thing is, you got to get started as quickly as possible. The time variable is the most important variable to compounding interest and returns. But without the time variable, it's just not going to work. The second is you can use tools and strategies like location arbitrage, which Johnny's using, to increase your savings rate. Derek's not really doing that because he's in Los Angeles.
Well, I'm also very reliant on my income that is based in Los Angeles. Exactly. So if I had more of an online income, I think I would definitely consider it more.
Exactly. But I think for like Johnny's case, he's making 6 figures, basically running online channels, and he's living in one of the cheapest places in the world. So he's got like a 90% savings rate, right? So he's increasing his savings so he can invest way, way more than $5,000 a year. He can invest more like $50,000 a year, which is going to accelerate his timetables massively. And that's what this is all about. It's shrinking that 75-year time frame, or even the 40-year time frame that we showed you. You can easily become a millionaire by just sticking to that disciplined investing for 40 years, shrinking that to something that's more palatable, which is more like 15, 20 years, right? Mm-hmm. So these are some of the tricks that you can do. You can maximize your employer match 401k. That's literally free money for most people. It's nothing I've ever been able to I've never been offered a 401k.
I can speak to that. In my 20s, I definitely had jobs that had 401ks, and I don't think you're eligible till you're 21, or at least was the case when I was 21. And literally on my 21st birthday, I signed up, and the company, I think I was working for Target at that time, and it was just a college job. But I took advantage of that. That was one thing I did in my 20s properly, is they would match a certain percentage. And I said, max it out, whatever I can do to put in that they'll match the exact same amount. I also did it when I worked in radio, Clear Channel back then was it. Not much of a match, but anything is free money. So it was, I took it, and I still have that money to this day because I rolled it all into an IRA. One thing is too, if you leave a company, the smart advice is to get your money out of there as soon as possible and get it into an IRA. Don't leave your money with a company that you're no longer a part of, but do take advantage of that free money.
I think that's an interesting point. I wonder how many people don't invest in or don't take advantage of that because they're afraid if they leave the job that it might be dicey to get that money out or into a new account.
No, it's really simple, and they don't advertise it to you, but it is easy to roll that money over into an IRA in your name, and that has nothing to do with any of that company that you are no longer a part of.
So that's literally free money from your boss. So definitely take advantage of that. And then there's other ways depending on what country you're in. Like if you're in the US, you can set up a SEP, or you can set up a self-employed 401k where you can increase the amount of money that you can put in every single year. I think if you have a Roth IRA in the USA, you're allowed to invest. I think it's 6,000 right now. It's either 5,500 or 6,000, and that's great. That's along the lines of the numbers we presented earlier. But if you're making more and you can invest more into some of these tax-free or tax-deferred or tax-free savings accounts, then it's way better, right? If you can get 10 or 15 or 20,000 in there a year, you're going to accelerate your timetables a lot. Then we talked about 9% and 7%, but historically S&P is getting 10% or even more, 10.5%. The perfect portfolio that Paul Merriman has gone and back tested is getting 12%, right? So you can increase your odds of getting higher returns by tilting your portfolio historically by tilting it towards small cap, tech, and of course stocks. So you take a little bit more risk, you're a little bit more aggressive, you stand a good chance to edge out 7%, 9%, even 10%. And then the final thing is just kind of talking generally along the lines of, all right, you want to supercharge your savings and earnings, right? So if you're going along, you're getting the 5,000 a year invested, and you're doing this disciplined thing, and you know where you're going to get in 40 years, but hey, you're also taking advantage of employee stock options, or you have some side hustles like Derek has. You're investing maybe in real estate and leveraging real estate to increase gains. You're just asking you're doing hard work and you're asking your boss for a raise, and you're staying at the high end of your earning ability. Well, all this is going to help you earn more money and again, accelerate your timetables. But if you can have, you can be chugging along at kind of your 5,000 a year annual savings, and then all of a sudden your employee stock options become valuable, and in 1 year you might make $250,000 off those, and then you invest all that, and boom, you've just taken like 10 years off of your $1 million required to get to $1 million by saving discipline.
All that's great. And I really love that you brought up the point about asking for a raise. That was something I was always leery about doing, but I tell you, every time I've asked for a raise, you make your case, I've received a raise every time I've asked for a raise. So that's one of the simplest things that, someone could do tomorrow to really increase their income.
I've heard countless, I would say even more cases than not, when people have gone in and said, hey, I want to, if they're a good employee and they say, hey, I want to, I'm looking to leave, like I want to leave, I want to do something else. Almost all of or like I want to go travel, for instance, almost all of them have been offered jobs, their same job, just remotely. Mm-hmm. And when you work remote, I'm not trying to give people, ways on, in a sense, taking advantage of their employer, but when you work remote, it's much easier to pick up side hustles, right? Because you're not constantly under like the watch of everybody. So if you're not able to get a raise, ask to work remote. If you can work remote, consider starting a side hustle.
And I think that's what we saw with COVID. I mean, everyone figured out, I'm at home, I got time to do other things.
Yeah. We'll start a YouTube channel.
Right. Let's move on.
So Johnny, unfortunately, was not able to attend this call. So we put some words in his mouth for him. We put up a nice little photo of Johnny. I don't have a Johnny impersonation. I can't do his voice impersonation. So anyways, we'll just say, here's some advice from Johnny. So Johnny's chiming in and he says, okay, guys, I like all those tricks that you just mentioned. I agree with all of them. Here's a few extra ones. So first thing is, when it comes to savings, you want to pay yourself first. And what that means literally is, like, when your money comes in, if you have a paycheck coming in, don't spend all that money and then think about saving some at the end of the month, or even saving some at the end of the year, because chances are you're just not going to do it. So when that money comes in from your paycheck, you want to set aside money immediately for savings and investing. So you have $5,000 come in, you take some straight off the top right when it comes in. So you're not spending it first. You're paying yourself first. You're investing first. And then the second part of that is you want to make it automatic. If you have to go and log into your bank account or write a check and manually transfer money into savings, the chances are you're just not going to do it. So you want to make it automatic. Whenever your money's coming in, set it up so money's immediately going out into your investing account. So pay yourself first, make it automatic. The second thing or the third thing actually rather, is fees. And that's just a core narrative of this podcast and our learnings, is you got to keep fees down. So earlier we talked about the difference in wealth creation of 7% annual gains to 9% annual gains. And I hope everyone can now appreciate just how important just 2% a year is. So you want to keep the fees close to zero. The best way to do that is just some low cost index funds. We love Vanguard, but there's lots of other ones out there. And you got to keep advisors, if you can, which we hope you can, keep advisors out, because they're just going to charge 1% or 1.5% to do something that we think is totally unnecessary for them to do. Tax-free is also really important. So we had touched on earlier, investing through such a vehicle such as a Roth IRA. That's what I'm using in the USA, but depending on what country you're living in, there's probably a comparable option there for you. And you also want to, when it comes to investing in index funds, which is sort of the vehicle of choice that we talk about and kind of core to this episode, you want to make sure that you have your dividends reinvested into those funds. So best practice is not to let the cash pile up in a cash account and then go back and invest it at some point. You just want that money to automatically be reinvesting and buying more shares of those index funds. One of the last points, and I think Johnny has been probably the best example of sticking to this rule, is don't give in to inflationary lifestyles. As you start making more money, the tendency is you're going to go out, you're going to spend more money, you're going to show it off. You want to feel like you're making more money. So you go out and you get a nicer car and a nicer apartment, and you start flying business class. But that's an inflationary lifestyle and it kills your savings rate. The last one Johnny has for us is just don't make that big investing mistake. Most people do. And that investing mistake is market crashes, you panic, or unfortunately, maybe you also have a life event at that time. You need to sell stock. But when you do that, that is the biggest investing mistake. And it's very difficult to recover from, both just financially, but also from confidence. That happens and you sell at a low point. It is tough to get over. It happened to me in 2008. And I sold and lost 30% on my investment. And I was just getting out of college, and it was so brutal. But it's important to study market cycles. It's important to be in communities like we have our Boss Lounge and Invest Like a Boss. And once you've been through a cycle, you start to understand it. They all feel the same. It feels like the world's ending. But historically, every single one of them has rebounded. And recently, they've been rebounding much, much quicker. So don't make that investing mistake. It's hard to get over. But with some education, a little bit of practice, and learning about market cycles, you should be able to avoid it.
Yeah, and luckily those market cycles usually occur, at least once a decade, and this did just happen, less than 2 years ago. So I hope the people that are new to the market really kind of learn some lessons from the early 2020 and how quickly things really did bounce back. So I think we got to talk about this too. We've hammered down the point that your money can grow exponentially, but let's just break out some numbers for you to hear. And if you're watching visually as well, if you're just earning 7%, like we said, 7% is easily achievable. Your money will double every 10 years. Now, where we said, that 1 or 2% advisor fee makes a difference, here's where it really makes a difference. If you're just making 1% more at 8%, that money only takes 9 years to double. 9%, it only takes 8 years. If you make 10%, which is very doable, your money should double every 7 years. That's pretty awesome. And like we said, lately, at least, we've been earning at least 13%. Now, if you take it down to 13% a year, the money you put in to the market will double in just 5.3 years. So what's that? 5 years and like 2 months.
Yeah. And then double again in another 5. And then that doubles again in another 5. And then that's when you start seeing this exponential growth start to kick off. And when you package it up like that, like if there's one thing you take away from this episode, it's like, hey, at 10%, your money's doubling in 7 years, right? So the opportunity cost of not being invested is just like, it's so immense just to have cash sitting there. But it also, this again is just, it reflects and underscores the importance of getting started early. If if you have a nephew out there, if you have a child or a nephew or just anybody that's young, and they have, access to capital or earnings, even if they're just like mowing lawns or getting allowance, like getting $10 a week for allowance, like starting to invest at an early age. And like, yeah, 30 is great, but what if you start investing at 20? What if you start investing when you're 10? Your allowance is when you're 10. I mean, you tilt the odds in your favor so drastically by getting started early.
Totally. And a lot of this is money while you sleep. So you don't have to actively be watching it and thinking about trading or any of that stuff. It's really jumping into index funds. And, we talk about them all the time, but Vanguard's our favorite. There are some newer competitors to Vanguard now with the low fees. And when we're talking low fee, we're talking like, what Sam, 0.2 or less, or maybe 0.1 or less.
Yeah, I think Vanguard's S&P is 0.03%.
Yeah, which is wild. 0.03.
It's basically free.
Exactly. Some of the ones that we recommend, VT, which is really Vanguard's complete portfolio of as many world stocks as possible. It's about 8,000 stocks in the VT index fund. The one we talk about a lot is VTI. Those are mostly American-based stocks, 3,600 stocks. A lot of people think that's just the S&P 500, but VTI is actually a lot broader than that as well. Mm-hmm. So these are really broad funds that we like to recommend to just sit and hold your money. Like I said, you don't need to be. This is very, very passive. Any other funds to look at? Maybe like some small cap or tech. VBR is a small cap one, and Vanguard's tech fund is VGT.
That's one we've been talking a lot about recently as a benchmark comparison to the metaverse portfolio, which has been fun to watch.
Wild roller coaster on that one. All right, moving on.
Moving right along here. So just some kind of support on why we think that index funds are awesome. One is chiefly that it's got a proven historical track record going back more than 100 years now. When it comes to our investing philosophy, mostly we like to be totally passive and also location independent. So these check both of those boxes. You're never going to have to do a phone call for your VBR fund. So this is all passive. Dividends come in passively. And one thing that's also cool, like if you're investing, if you have index funds and you have the cash being reinvested automatically, one thing to always remember is like, hey, if down the road you want to retire off these index funds, you just turn off that auto investing, and that's as good as cash. And most of those funds, a lot of those funds are distributing every single month. I know in my Vanguard account, I'm getting distributions every single month. They're a little bit lumpy. Usually quarterly, you get bigger lumps, but it's absolutely possible just to live off the cash dividends coming in. So it's another thing to keep in mind.
And assuming things don't change too much drastically in the future, dividend tax rates are also a lot lower than standard income tax rates too. Yeah.
For sure. And these index funds, you can basically invest in almost any asset category, but you get broad diversification, whether it's across the world as a geography, but also against different asset classes. Like, of course, you can invest in real estate companies through Vanguard, of course, technology and commodities, et cetera. So you get mass diversification with no responsibilities, no management, you're location independent, there's proven track records, and you can also get a mix of both growth and income. So you can tilt it more to income if you're older and you need that cash, or you can be more towards growth, which is right now it's mostly surrounding tech. If you're younger and you want to try to outperform, which you can see if you can get that 10 or 11% on up, you just accelerate your timetables massively.
Yeah, and Johnny said it a million times. The perfect investment is an index fund. If we just did that and left everything else alone, things would be great. But
we'd be so much better off.
We like to get ourselves caught up in other nets too. All right. Yeah. Sam, let's talk about index fund performance.
I hope Johnny doesn't mind sharing this. Well, actually, okay. Well,
I think he's okay.
So this is this for people looking in visually, this is just an example of an account that's got three funds. It's VBR, VTI, and VXUS. And so those funds are VBR is small cap, VTI is the total market stock market, but it's actually total US stock market. And VXUS is the Vanguard total international stock market. So if you're just picking one fund, you really you want to have stocks globally. Some people would say you want to have stocks, but just US based, because US based is really global, because most of the companies in that are in fact global companies. Historically, you want to tilt towards small cap and value. But in this particular portfolio, you have VTI, which is a US companies. So this particular person, not saying names, tilted was able to basically diversify it by adding that VXUS international fund, but also they tilted it towards small cap, which again, historically will give you better performance than not. So that's for you to decide, but you don't have to get super complicated with this. This is a 3-fund portfolio. I have like 15, but it's totally unnecessary. You don't even need 3 funds. You can use 1 fund. You can use 2 funds, 3 funds, 5 funds. But this particular portfolio, this 3-fund portfolio, has actually outperformed my 15-fund portfolio. And this has plenty of diversification. So you're talking about total global stocks here.
All right. So Sam, why do the rich get richer? That's the old saying. I think it's because of compounding interest.
Yeah. So you think about it. I mean, I was running today and I was like, man, it's ridiculous. Like if you have $10 million invested in one index fund, you can sleep through the entire year, and assuming the market performs historically 10%, you just made $1 million doing absolutely nothing with no phone calls, no worries, nothing, right? Yeah, of course, there's always worries if you have that much money in like an index fund. I mean, just because you're going to see some volatility in it, but the wealth creation is incredible, right? Now, if you have only $1 million in, which is still a lot of money, you make 100,000 at 10%. But this is why the rich get richer, because they're not like they basically can't even help themselves, right? If you have $100 million invested, you're out on your yacht, you're doing whatever you want all day. You might not even do this. You might have someone manage it all for you, but just by the market performing the way it has historically, you're already that 10% is $10 million, like more than you can actually spend in a year. You can blow 10 million, but you can't spend it, right?
Right.
Practically, you can't spend it. So this is why the rich get richer even when they're not even trying, because the more money you have invested, the more time, the more your returns. It's almost unfair.
Well, we're hoping to get everyone to that level, so we're going to play the unfair game as well.
Yeah.
So how about some more resources on this? Obviously, you're listening to our podcast. It's Invest Like a Boss. If you're new to the show, we have over 200 episodes now on so many topics. There's, between Sam, Johnny, and myself, that's just 3 routes to take of where we've gotten to, but there's hundreds of routes, if not thousands, that we're still learning about all the time. We have a link to an article, a great article on compounding interest. The link will be in the slideshow, and we'll also put it down in the show notes. We have a cool little calculator too. If you guys don't believe these numbers, it's not made up. So you can put in whatever you're saving a year and figure out how many years it's going to take to get to 1 million, 10 million, even that 40 million if you want to get there.
It's super fun. It's super fun to play with. And we also updated our getting started page. And what we found is pretty much everyone that emails us or writes in Boss Lounge or contacts the group in any other way, it's always very similar questions. And we all get started investing at the same point. We're worried about the market. We don't understand it. The market seems like it's at all-time highs. We just came into some money or just have some disposable income that we want to start investing. But generally the questions and the hesitations are all the same. And so what we found is, like, typically with friends and family and people that are new to the show, we usually email them or message them and recommend kind of the same 10 episodes. So we have 200 episodes now, but there's sort of like the first 100 are really more like the kind of core fundamental ones, because we were recording those honestly just to scratch our own itch. Like, it was all of our early questions about investing. So a lot of that stuff in the first 100 episodes is really the fundamental stuff that we'd recommend you starting out with. But we went ahead on the getting started page on Invest Like a Boss, and we suggested the top 10 episodes for anyone that's a new beginner. And this episode will actually be included in it, because we think making sure you understand the math behind compounding interest is fundamental to growing your wealth and your interest in growing your wealth. So that's also up there. And then a few different books that we commonly recommend. There's The Simple Path to Wealth by J.L. Collins. Money Master the Game is probably the one that we recommend the most. And that was written by Tony Robbins. It sounds like a lot of fluff, but it's actually an incredible kind of 101 book that'll really pique the interest of anybody who reads it in investing. And then one of the classics, of course, is Rich Dad, Poor Dad. So anyone that's just getting started, make sure you read those books or listen to them on Audible.
Awesome. And a few other resources for you here at ILAB is the Boss Lounge. Pretty simple. Just a Facebook group we have with a lot of like-minded people. You can join when you go to investlikeaboss.com. And while you're there, if you want to get to that advanced level where even more access, you can watch this video. And we have over 2 years of content in there now. Some really great talks with previous guests where you can ask questions, suggest people you want to see on the show, so much more. But the major level bosses are in our Patreon. So if you go to investlikeaboss.com, click on Become a Patreon. It's as little as $5 a month. And I think we've really given a lot of value in there. And you know, in a world where Netflix is $20 a month, I use Patreon a lot more in ILAB than I use the crappy Netflix movies.
And Derek promises that he's going to figure out how to add a Discord chat to the Patreon group. That's
they always put the tech stuff on me. I'm like the old man of the group. How do you work this thing? All right, we'll figure it out. Really quick before we get out of here, though, one way you guys can help the show. If you found value from this episode, please share it with someone, especially those people that you've been trying to get to invest and they haven't listened to you. I know I have so many people in my life I've told things. They're like, how do you do this? How do you do that? And then you tell them and they can't wrap their heads around it. I think this episode will be a really easy starter way for people to get involved in the market and really show some interest. So share the episode with them and also leave a review because that helps share the show as well. On Apple Podcasts, 5-star reviews help a ton, helps us get these great guests on and really motivate us to keep doing the show. So I just had a great one the other day, actually from Matco Haig. He says, these guys have completely changed my outlook on investing and make it entertaining. The things I learned about the stock market and alternative investments are worth their weight in gold. Keep up the great work. We love hearing reviews like that. And really, it's the reason why we do the show. We're not getting rich off this show, but we do really get inspired when we hear about you guys getting rich off it.
Sometimes I think that we are getting rich off it just because we're making money with investing, but actually, if we had just stuck to Warren Buffett's advice, we'd be doing much, much better. But to Derek's point, because we like to bring new content to the show, we're often making tons of new investments, way more than are necessary. But it is fun and we're still doing well. But I hope this episode has been useful for everyone. I think even if you're a seasoned investor, it's important to remember how important compounding interest is and just letting the money work for you, being disciplined, keeping it in the market, not pulling it out, reinvesting those gains, those dividends. Some people have read Warren Buffett's book called Snowball. It's very much the same concept. But also, if you're just a beginner, just seeing how important getting money into the market as early as possible is, even if you're investing $100, just get started. And in some of these, earlier in this conversation, we showed how anyone can become a millionaire by just investing $5,000 a year for 40 years. But let's accelerate timetables. There's a bunch of tricks, but get out there and make it happen. I think the narrative is work hard, make money, retire early, have fun, do good. That's pretty good. That's pretty sound life advice. And certainly hope you guys have a great 2022 and let's make it a better year than 2021. Although every year is a great year. Let's just keep rocking.
Awesome. Thanks for putting this all together, Sam. If you guys have any questions, you can hit us up, Boss Lounge, Patreon, anywhere out there. I hope you got value from this. Like I said, please share the episode with someone who is new to the market or is interested in investing. And if you found value in this, definitely let us know. We'll talk to you guys next week.
Thanks for listening to the Invest Like a Boss podcast. Join our mailing list at investlikeaboss.com to get exclusive access to our insider investment portfolios and our private members forum.
If you enjoyed this episode, please subscribe on iTunes or your favorite podcast app. Tell your friends and leave us a review in the iTunes store. It helps more than you know. See you guys next week.